Okay, welcome to episode 30 of the Corporate Real Estate Insider Podcast. Today is a special day because not only is it the 30th episode, but it also is Brian's dog's birthday. So you best believe that we will be bringing the heat with this episode today. A lot at stake. We have to honor Brian's dog. Brian, I know you have a few things you want to talk about. Why don't you kick us off? But first, why don't you tell us what your dog's name is?
So my dog, she's 5 years old, and her name is America. So she is, a priceless piece of American history at this point, being 5 years old. But let's dig in. I have an interesting observation that I think will create a great conversation, and it's a culmination of a number of events. And the most recent one being, so I'm working with a client that's just under 100,000 feet, and we're looking at a number of locations in this particular market. And as we go through the process, there are a number of direct options in the market. This is outside of Boston; it's not local, but there's a number of options in the market that are direct. There's a number of options that are subleases. The process we've gone through is taking 15 options. We can bifurcate the requirement. We can keep it as a single requirement, keeping 15 options down to touring about 8 options, 10 options with multiple scenarios within each option. And the observation I've made, and this is something I think I'm going to take forward into the way that I work with my clients and making sure the teams that I put on listings provides the level of service that I would like to see. But what my observation is that the brokers that are representing subleases are not doing what they need to do to bring the best opportunity forward for those particular tours. They're mailing it in is what they're doing. They send the junior broker from the team that doesn't have a clear understanding how buildings will divide, doesn't have clear understandings of how a single tenant building will become a multi-tenant building, how floors can break down, all of the questions that you would expect to have, and not difficult questions. But as companies show up and there's high demand, high competition in the marketplace for these requirements, there's simple questions like, take me through the experience I will have in this building as a tenant that's going to be a large presence. And it's not, a lot of times it's not the brokers that show up's fault. It really isn't, because they're the youngest people on the team. They're the ones that are spending, 8 hours a day in the car, just running around doing showings for these high volume teams. They're put in a position not to succeed because the work hasn't been done before the day of the tour to engage with architects, engage with the clients, really come up with the story to tell that when you show up there with a new tenant trying to look at a building, you have a clear vision of what you will get in that particular option. And I'll tell you, in this process, we've eliminated options that didn't have their ducks in a row, because there's a lot of options that do, and the client is in a position where they need to eliminate options, and sometimes just not having a clear and confident feeling about what is being delivered is enough to take somebody off a list. So I was a little disappointed in some of these particular options that I thought could be really good options, and they ended up not getting there. Love to hear what everyone else thinks really about this topic.
I think the best sub-landlord or landlord brokers, people that are presenting a space to a prospective tenant who's touring, are those that know how to sell the property, because we all know that people have options. And, I find it best when I, prior to a tour, landlord broker reaches out to me, asks what's important, what the client's looking for, maybe where they are today, if we're willing to disclose, and really try to figure out, with what limited knowledge they have, of course, how to best present the building, versus trying to swim in a sea of sameness. Because after all, if you're looking downtown, any city USA, there's a lot of skyscrapers, a lot of buildings, or if you're in suburbia, things can start to blur together. So what is it about your building that makes it the best option for our client. And whether it's true or not lies in the eyes of the beholder. But I think too many times people show up, just flip the lights on, and then go stand in the corner and sit on their phone and answer emails. And I'm not suggesting they should be selling it like a used car, but really, like, you've got our attention, and we're there in person for probably 10, maybe 15, 20 minutes. And that's the last time you're probably going to meet my client. And that's the last time we're probably going to be there in person, maybe while you're present. And so what you do in that first, 10 to 15, 20 minutes, and how you explain and articulate the value of being in that building is really critical. And we as sublandlord agents, when we have subleases that we're trying to dispose of on behalf of our clients, I make it a point to be there and do the same thing as I'm talking about. And it doesn't mean I need to be selling a false bag of goods and suggesting things that are exactly true. But given what I have, I try and make the best of it and make sure I'm there to answer questions. And oftentimes as I'm talking and presenting the offering, there becomes a discussion, and it's a lot of back and forth with the client, not so much the broker, where we're just kind of talking about, what we're offering and what they're looking for. And that conversation then leads me the ability to draft a proposal, assuming we are engaged in a short list, that best suits their needs. And that's sometimes insight, you guys, that I wouldn't have got from a written proposal. It's only things that I garnered from that conversation with the prospective subtenant. And so when I tour subleases that are represented by somebody from a competing firm, and they either send their junior broker who's been in the business for a year or two and doesn't really know what is up from down, and they're just opening the door, what a missed opportunity that is for that tenant. And I think if they only knew that their broker wasn't showing up, and that the space is being so poorly presented, they might have chosen somebody else.
I think this is part of a broader discussion around the lack of intentionality and commitment in the brokerage community in general, which has really been exacerbated after the pandemic, right? Brokers work significantly less hard now than they did 4 or 5 years ago. I mean, I would go as far to say that on average, I bet the typical broker in corporate real estate advisory that's been doing this for over 20 years probably works at least 40% less hours than they did in 2019. And this is causing a lot of apathy and a lot of reduced performance, both on the tenant advisory side and also on the landlord advisory side. And there are instances where there are people that are really hardworking that want to be at the sublease tours that simply don't have the opportunity to be there because the people that are coming to tour provide so little notice. I mean, I think about the subleases that I'm working on right now, and my goal is to go to all of the ones that I possibly can. But at the same time, it's not realistic if you're, representing a 30,000 or 50,000 foot sublease or something, and somebody says, "Hey, I need to be there to tour later this afternoon," and that's the only day that I can do it. And I think that I've noticed a dramatic uptick in very last minute type of tours compared to how things were done maybe 5 years ago. And you can never expect a successful broker to be available to go meet you somewhere in 4 or 5 hours. Like, it's just not realistic. That said, there's a way to handle that type of situation. Hey, can we tour another time? And if they can't, then okay, we're going to figure out how to get you through. And here's everything that you need to know about the property right now, right? I think the outsourcing of information and sort of like selling the property, sort of like persuasion through storytelling has really been lost. And it's been sort of foisted upon people that are not sophisticated enough, that weren't there, that don't know the story, and that really have no idea what tenants want to see. I mean, a very high level comment. I mean, when people talk about listing brokers potentially being reduced in their capacity over time, or having the fees that they're paid by landlords be reduced and things like that, I think people that believe that think of listing brokers as glorified tour guides, which certainly there are many that are just glorified tour guides, but the really good listing brokers are so impactful at explaining the opportunity, making it a positive experience, and having the tenant feel like there's this energy when they walk into the building, and it's not just this, cold shell of a warehouse or office building or whatever. And those brokers really create tremendous value for these landlords. But unfortunately, I think the number of people that fall into that category are few and far between, because they don't understand exactly what tenants want to know, and they go on this 20-minute monologue about the planned amenities that they have coming that people might not care about, instead of leading an effective tour.
People buy with emotion and justify with fact. And the experience they come away with after a tour is profoundly affecting their interest in whether or not they want to pursue that option. Because recognize everything they're pursuing, or they're touring rather, is stuff that works. Otherwise, their broker would have never put it on the tour, presumably. And so the experience they come away with largely has an impact on whether or not they pursue that building, even if it's the most expensive. And just remember, again, people buy with emotion and they justify with fact. And it's not to suggest that people make only emotional decisions, but the experience that Tucker's referring to has a huge effect on whether or not buildings are pursued. In this case, in this discussion, possibly a sublease you're promoting.
Yeah, I think you're spot on. So I hold really every listing broker or sublease listing broker to the standard of the best listing brokers in the market, and the best listing brokers I've seen in any market, because they really do tell the story in a way that is highly advantaged to their building and to the space that they're leasing, and they're good at it. And there's a value to that, and I truly believe those people are very talented at what they do. I feel like the marketplace is broken between listing brokers that work for landlords that hold them to a very high standards, and then tenants that have brokers that work on these projects that don't really understand the industry well enough to hold them to the standard. And the brokers are, and I truly believe it's more of the larger broker firms, are in a volume game. So they are taking on as much work as they possibly can right now to create the same amount of revenue for their firms. So you've got to take on more listings, you got to take on more subleases, you got to take on more clients to generate the same amount of revenue for your firm, because everything's getting smaller and things are happening slower. And what that's doing is requiring these people to add more people to their teams that don't have the value or the talent or the experience that these brokers that are winning the business and talking to their clients do. So you're ending up with the third or fourth person on a team that's new. That's not their fault. They're new. They're trying to learn, but they just don't have it. And the game used to be, when the market was tighter, was you send those younger people out. If the client likes the space, if your client likes the space, then the more senior broker will engage and then be the one negotiating the term sheet or doing subsequent tours and such. Well, that whole game has been flipped upside on its head, because you only have one shot. When there's 20, 30 options in a market, when we're driving by buildings and every fifth building or fourth building is vacant, you only got one shot, and you've got to bring your A team to those tours, or you're not going to get an RFP. You're not going to get to the next level, and your client suffers. And I think that's fundamentally what's broken here, is that this whole volume game that's being played by these larger firms in a market is delivering a product that isn't meeting the needs of their clients, especially sublease clients today.
Yeah, when you talk about what's fundamentally broken, I might also offer an explanation. The reason these senior listing agents may not be showing up at every tour is that I think there's a general tendency of brokers in the market. They just generally don't run a crisp tour. There's a tendency to lose control of the tour, to run late, and to just expect the listing agent to stick around when you're 30 or 40 minutes late to the scheduled showing. I mean, what a brutal way to spend your day as a listing agent, just sitting in a building waiting for a group that's running late. I take it as a point of pride. I think likely we all do, to run a really crisp tour, to stay on time. And if by chance we're running late, let the listing agent know, text them, call them, have our ops partner let them know we're running 10 minutes late. Maybe they can fit in a phone call in between. But I think there's a tendency for tours to be brutal on listing agents. And we could all, on the tenant side, I think we can all do a better job of running crisp tours, staying in charge of the tour, keeping folks timely and showing up when scheduled.
I think the takeaway from all of this is really probably the most important question that a director of corporate real estate can ask when hiring somebody is who is actually going to do the work, right? The amount of large like corporate account work where there is a figurehead who is essentially the relationship manager who has a lot of like brokerage experience on paper that actually does nothing except manage a network of junior brokers that are way less skilled negotiating is disturbing. If I'm a director of real estate and I'm interviewing brokers, the number one thing I care about is who is actually going to do the vast majority of the work. And it's even things that certain people may say, that's a commodity, it's not that big of a deal. Like drafting proposals, like the amount of tenured brokers that represent these big accounts that don't even know how to redline documents is truly mind-boggling, right? Like finding brokers that have really high technical wherewithal, that know how to transact, that know how to do every single part of the transaction process. And of course, successful brokers are going to have people that are helping them to make them more efficient with their time so they can help more people. But that's by far the most important thing. I think people would be surprised and disappointed if they knew the percent that these like relationship managers are actually doing from a work standpoint. And I don't know how you ever shine light into that, but it's really important.
So to transition this a little bit, there was a story that came out, I think maybe a couple weeks or a month ago, about a senior investment sales broker in New York by the name of Bob Knackel, who was let go by JLL. And the story goes, at least what I'm reading in the paper, is that he had created too much of a personal brand, and he had written or done an interview or written an article where he only referenced the firm JLL one time, and it was the response of the firm that we put our clients first, we put the firm second, and we put individuals third. And it got me thinking about my something that happened early on when I was at the firm, and Colin Dyer was the CEO, and I transitioned to a new CEO by the name of Christian Ulbrich. I think it was in like 2016, and Christian grew up in the real estate industry in Europe, which is very different than the States, and his perspective was, we need to increase the margin on brokerage revenue in the United States, and the brokers here are like, okay, what's that mean? And what had happened then after that was he started adding lots and lots of brokers, because how do you increase the margin in brokerage revenue? You keep everybody's revenue where it's the highest margin business. So at the time, I think everything was below $750,000 in revenue per broker. So you add and add and add, and then as they say it, the client's first, obviously. Second is the firm. Well, the firm controls a lot of corporate business. They push that into the markets to individual brokers to execute it. What do they want? They want lots of brokers executing at this first threshold, which gives it the highest return to the company. And what does that produce? Mediocrity. And we all saw it 10 years ago at JLL, like, wow, this is going to make a really mediocre team. And then you start to peel back the onion, and all of the firms are doing it. If you look at the size of the brokerage teams in major markets, it's unbelievable how many brokers they have. And I bring this up not to challenge these large firms that are highly successful, that have really smart people at them, but to look at it from the perspective of my clients and how we do business and what's important to them. And it translated back to this whole discussion around subleasing. You want, yes, the client is first, yes, the firm is second, but third is the person. You want the person being the one who brings the talent, brings the experience, brings the value, the same person that showed up in your conference room when you hired them, to be the tip of the spear in the market. And I think the models of these major firms have, because of their own self-interest in driving revenue and margin, has really gotten away from what's really important, which is the client. And the client wants their top brokers. They want Bob working on the assignment, not the next guy in line who's going to create more revenue for the firm because he's at a lower margin than what Bob was at. But they don't want him there because he's creating a personal brand that's driving more revenue to him rather than the firm. And it's kind of this cyclical thing that's really, if you have to really dig into it to understand it. And I think what I was talking about around subleasing is a good example of this. And what happened in New York with Bob, I think, is just a result of him driving too much revenue to himself, and they'd rather have the firm spread it out among people to create a higher margin business for New York real estate at JLL.
Just to explain a little bit what Brian's saying in case people aren't as knowledgeable about how brokers are paid. Usually there's a progressive split structure. So if you're a broker at JLL or CBRE or something, the first X dollars of revenue is going to be at 1%. And then as you go above that threshold and do more and more, generally the brokers keep a progressively higher portion of the revenue that they bring in. So when Brian's talking about how do you increase brokerage revenue, well, if you have, $100 million of brokerage revenue and 80 million of that revenue is being generated by 20% of the brokers, well, that $80 million is going to be give a higher percentage of that money is given to the brokers. Whereas if you can have the revenue evenly created, then probably nobody is going to be able to take advantage of the higher splits where the broker gets to keep a higher percentage of the revenue. So I just wanted to make sure everyone understood that, because I know that many of our listeners are, in-house at companies and might not be super in the know on how brokerage splits work.
I think that's fascinating and really, really interesting and important that you pointed out, Brian. And just to say it another way, literally the structure, the incentive of the large company that has that kind of progressive commission schedule for their agents, they're incentivized to field moderate performers, and they are disincentivized to retain the top performers. Like they want a pyramid that's very broad at the bottom and not too high at the peak. They do not want a pyramid that's really high at the peak with just a couple of really high-end top performers. But if you think about the service delivery to the customer, what's the cost of that approach? Really interesting conflict.
I think part of the reason these big companies don't like powerful, really successful brokers on their team is that it doesn't closely align with all of the other services that they're cross-selling. I mean, when you consider that, most of these big brokerage firms are getting greater than 50% of their revenue simply from property management, right? You start thinking about, okay, this one person is too powerful, controls too many relationships. We want to be able to reinforce these relationships with many, many people at the firm. So if somebody leaves, that relationship is still ours and we'll be able to retain it. But I think that there will be a new era of brokerage companies that emerges at some point that really recognizes that, yes, you have to put the client first, the occupiers, like in the case of the four of us, the occupiers we represent. But the reason brokers work at companies is so they can do a good job for their clients, right? And when you think about it with that framing, it's like really the best brokers are going to be at brokerage companies that provide them value that they can then turn around and provide to their clients. So when I think about like, how do you create value for brokers? Really, you create value for brokers by helping them be extraordinary for their clients. And the big thing that a lot of these larger companies are missing is being able to get all of the services that brokers need to the brokers and to their clients in a really short duration, right? Of course, all these big brokerage companies have all of the services and sophistication that you could possibly ever need, but they don't have it on a day-to-day basis or a week-to-week basis, right? There's this massive lag and latency that exists. And hey, we need to do this labor survey, or hey, we need to start working on this project in this market. Things can't happen really quickly. And for companies that need to move fast and make things happen, I think that's a big weakness and has caused a lot of movement at big brokerage companies to go to other firms where the services the brokers need to do a good job for their clients are more readily accessible.
All right, shift gears here. Let's talk about the workplace, something I'm always excited to talk about. And I happened to read an article this morning in the Wall Street Journal, and for anyone that wants to read it, the article is titled, Virtual Meetings Are Killing the Vibe. Here's what to do about it. So naturally, given what I do every day, I was interested, read the article, and it's about this author named Priya Parker. And she wrote a book called The Art of Gathering. how we meet and why it matters. And so before I went further, I went to Amazon to check out the book to see if it was actually, well reviewed. And sure enough, it's got about 3,000 reviews. And I think the rating was 4.8 or something like that, which out of 5 stars is pretty darn good. So I was like, okay, she's probably got something good to say. So let me dig into this. So Priya has been advising, companies and nonprofits for years on how to improve their gatherings. That's what the book is about, and that's what this article was about in the Wall Street Journal, which is in part a promotion for her book. And a huge part of remote work is what she says is killing the vibe, and that is our perception of one another, our understanding of how the work that we do as a company is done, our understanding of what the workplace actually is, and maybe what it's evolved to become. And it's primarily a result of these mediocre meetings. Some, or in some cases all, or many, are happening over Zoom, virtually. And she's suggesting that it destroys the core elements of group conversation, which is a feedback loop, call and response. And that's kind of how meetings are typically run. Now, I want to just stop this before you kind of tune out and say, oh, he's just hating on Zoom. I'm not. And she isn't either. She says there's a real good purpose for Zoom. It's just not all the time. So let me kind of keep going. And as you might imagine, she enforces that, the reason people, come to work and what they value in their job is making sure that they are building their skills as to what they do. Everyone, or I should say most people, want to scale in their careers. They want to know that their work matters, what they're doing, whether it's a mission-driven nonprofit or a for-profit company that's trying to solve problems or deliver service. They want to know it matters, and what they're doing, as part of a big cog in the wheel is making an impact. And they want to know and feel that they're part of something greater than themselves. And, gathering in person can reinforce those things. And that doesn't mean it has to be lavish. Sometimes people have this stress about, if we're going to have a meeting, it's got to be in this awesome place and it's got to cost the company tens of thousands of dollars. That's not the case. She actually goes on to talk about how that can actually have the opposite effect. And the lavishness, so to speak, can be a distraction from really the core elements of what the meeting is or what it's going to be. And so back to Zoom, there's a time and a place for great Zoom conversations. So think of your company, if you're a large organization, having a, say, 1,000-person Zoom town hall. That's really hard to do in person, right? And there's a lot that can be accomplished over Zoom, especially if you've got offices around the country, like Hughes Marino does, and many of our listeners do. Being able to gather everybody over one vertical for a town hall or a big meeting is great, especially if you have some remote workers. But for me, including Priya, as there have been too many instances, I feel like, where people just randomly default to Zoom, when in fact a phone call could suffice. And Zoom can be taxing. I speak for myself. I'm on Zoom sometimes, multiple times a day. And when you're staring at your own face, and you miss that mirror back and forth conversation with people live, they're actually, in some cases, more taxing than, just having a phone call. And what she suggests is that companies need to realize there are time and places for Zooms where they're highly impactful, but maybe a phone call suffices for others, and let people know that leaving their camera off is acceptable. And, she also goes into, we could go talk about Slack, but that's a whole nother rabbit hole we don't need to go down right now. But Slack's another vertical where it sometimes can replace the need for necessarily a Zoom. And then, last point, which I thought was really noteworthy because I ran into this last week with the client, is when you have a hybrid work scenario and people have the ability to come and go as they please to the office. Think about those Zooms you've been a part of where, there's 9 people, 8 people, 5 people even on a Zoom, and 2 or 3 are together in the office, and you and or one other person is kind of the odd man or woman out. That's really awkward because then you've got 3 people, in a room that, if it's on mute, could be having conversations that you don't know they're even having, and then you're this kind of odd person out that's at home. And so another example where Zoom isn't necessarily very effective. And so I say all this, and I'll wrap it up with the sense that, as we start to kind of re-enter the workforce, and more and more of my clients are coming back on a much more regulated schedule, think about the impact that meetings have with your team. And even for those that are hybrid or coming in, intermittently, when there's something that you really need to just kind of charge forward with an initiative or whatever it might be, having Zoom not even being an option. Whereas like, we need you to attend this meeting, and being over Zoom is not an option. Giving people enough notice can go a long way. And so anyway, long story short, ordered the book myself. I look forward to reading it. I'll report back on a future pod if it's any good. And again, the name of the book is The Art of Gathering: How We Meet and Why It Matters. So I'll report back in a few pods after I've read it.
It's such a fascinating topic. One that's, it's that you come at it from so many different directions. There was a interview this morning on CNBC with someone talking about just women in the workplace and the how companies are kind of figuring out the hybrid work schedule. And I get on one side why eliminating a Zoom option from a meeting is could be the right approach. But on the other side of it, listening to this conversation this morning and just all of this particular woman is just talking about the challenges of women in the workplace and how they're dealing with children and all of the other added levels of complexities of raising a family, and how a lot of it falls on the woman still. And not having a Zoom option for somebody who, is dealing with that, it's like, to me, it's too black and white. And what the result of the conversation this morning at CNBC is that you have to live in the gray and you have to live in the nuance. So I think companies are figuring that out, right? So you have a Zoom option, but you have very specific parameters of who can join via Zoom, right? You need to have it for the right people. You don't want to have certain people not have that sense of community and feeling and connected to the company because they physically cannot be there, right? You want to turn somebody away from the firm, make them feel like an outsider because they actually can't be there. And to rule black and white, to me, just doesn't seem like a place I'd want to work. And how do you get there? I think companies are it's a slow moving process for firms to figure out who they are as an identity. I'm glad to see that more and more people are, bringing real talent and information to this topic, right? Knowing that book is probably going to be very, I'll read it too, very interesting. But, what I took out of this is that I like that a lot of companies are living in the nuance and really becoming focused on who they are, not who other firms are, and understanding their people and being able to do a one-on-one relationship with what the right mix is for being in the office and not being in the office. And it takes a lot of talent, it takes a lot of people, it takes a lot of time. But I think those are the companies that are going to win in this war for talent and this new era of hybrid work.
Okay, let me bring this conversation back to some hard-hitting dialogue about real estate. We talk so much on this pod of late about the office market that's crashing in certain major metro markets. Life science is languishing. Even industrial, there's some softening that we're experiencing in the industrial market. So when I come across this headline, I think maybe we should talk about this. Okay, here you go. Developers are effectively out of space in major markets. Much of the anticipated 2024 supply will be pre-leased, resulting in limited options for users who are not on the market far in advance of their preferred go-live date. And 3, the average vacancy rate across North America stands at 2.7% in the third quarter of 2023. And in some markets, like Northern Virginia, the vacancy rate is about 1%. I mean, shouldn't we be talking about that if that's happening in commercial? What sector is that? Well, here you go. This is an article from Data Center Frontier by a gentleman, Rich Miller. It's the 8 themes that will shape the data center industry in 2024. And yes, data center is highly nuanced, highly specialized. I've done 2 of them. I've done 2 80,000 foot data center requirements in my career. They were 10 years ago. Things have changed. And so I just spent some time this weekend seeing what is going on in the data center space. And I found it fascinating. So I'm going to read to you from a couple articles. Okay, and I'm only going to cover the 2 of the 8 themes that will shape data center industry in 2024. Theme 1, the AI boom creates a data center space crunch. The challenging environment for data center capacity is beginning to be felt. Oracle's cloud revenue growth was slowed by the pace of its cloud deployments. Here's a quote. Frankly, the only limiting factor is our ability to get the data centers handed over and filled up fast enough, said Oracle CEO Safra Catz in the company's earnings call. This quarter alone, we're talking about hundreds of millions of dollars that we would have been able to recognize if our capacity was available. Goes on to say cloud builders are now leasing entire campuses, as seen in the recent pre-lease of 5 buildings and 430 megawatts in Northern Virginia in a single transaction. Okay, so I'm going to click over to that article, also by the folks at Data Center Frontier. This is by Matt Vincent talking about that transaction. It was TA Realty, leases 430 megawatts across the entire Leesburg data center campus in Virginia's Loudoun County. Okay, here's a couple things from that article. They don't name the service provider, a premier global cloud services provider. We could probably guess, but it's not named. They lease the entire 1.9 million square foot project. Go to what I've got highlighted. Loudoun County is home to the largest concentration of data centers in the world. Northern Virginia also accounts for approximately half of all built data center space in the U.S. per CBRE estimates. You know that. Okay, this is interesting. The Leesburg Council adopted 2 amendments to the town's zoning ordinance to allow buildings taller than 50 feet. The new 65-foot height limit would allow all buildings permitted in the district, but was developed data centers in mind. Wild. And think about what the shape and look of these new data centers is. Mitsubishi, TA Realty is owned by Mitsubishi Real Estate Group. Here's a quote from Allison O'Rourke, a partner at TA Realty. This is a sector that our firm has been watching for quite some time. We like the space for a number of reasons. The most obvious is that collecting and processing data is really the future of our entire economy. And that's driving data center growth. I think we're only scratching the surface of where that goes.
This sounds to me like if you have the initials AI in your company's, email address or bio, your stock is running right now, and everybody's chasing NVIDIA and Microsoft and the OpenAI boom. And if you look at what the computing power translates to data center requirements, the market is massively underserved, and there's a ton of capital sitting on the sidelines in this, in the real estate space, and they're looking for anything to chase. And this sounds like this is the area to chase. I would tell you that you could change the words of that article to be relative to the life science industry, go back 24 months and say all the same things, and look where that is today. I think, you've already had NVIDIA come out and say that their expectation on it being just incremental in terms of the number of chips needed to continue to grow, you'd need, it's not going to just keep getting bigger and bigger. They're going to find ways to get more efficient. I have a client, and I don't do their data centers, but I know their underlying real estate footprint is shrinking because of the computing power is getting more efficient. They don't need as much space to put as much power, not power, but actually computing power. And then their backup UPS system is getting smaller because there's less power needed because the systems are getting stronger. So the whole real estate footprint shrunk. Now the power consumption shrunk, and this is a cycle where they were going in massive growth mode, needing more and more and more square footage around the country for years. I'm talking 20 years, and now all of a sudden it's on the other side of it where it's getting smaller. So I just caution people as you look at this, like, are we just in a market where the AI boom is creating all this hype around computing power and the need to grow? And there's a vacuum in the real estate business right now where there's not a lot of asset classes to create a buzz and to park capital, and there's just a ton of money chasing it. And this is going to be the next life science industry when it gets overbuilt in a couple of years or months, gets overbuilt, gets oversupplied, demand shrinks, and then we're talking about how there's a excess amount of data center capacity in the country. I mean, we've all seen this story before, I think.
probably a lot of people that are listening to this podcast don't know very much about data centers. It's very niche, and a lot of directors of real estate don't deal with data centers, or they might use third-party providers. Just to put in perspective about just like how massive a megawatt is, 1 megawatt is usually enough power to simultaneously power about 750 homes. So when you're talking about 430 megawatts, that's the equivalent of like 325,000 homes of power, like all being online, all operating at once. And that's just one data center project. And it's probably not even one of the biggest. And there's so many of these happening. The other thing to think about too, as it relates to real estate, is that most of these data center transactions are done and sold not based off of square footage, but based off of power availability. So of course, as you're able to get more and more processing with less power into less space, of course, that's going to, create some, downward pressure for owners that are investing into this space. And they won't have the same pricing power that, somebody that can accomplish the same compute more efficiently will have. But it's just important to note that, even if the actual hardware for this compute gets smaller, you might have a 100,000-foot building that you're only using 80,000 feet of the floor space. But the reality is that the output and the thing that you're getting the lease off of, which is the total amount of power that you have available to the space, probably isn't going to change.
Well said. And I want to go back to Brian's point, because that's such an interesting and valid counterpoint, except you're just wrong. There's no way this is the bubble that's going to pop. This is the future of our economy. This woman said it exactly right. And the truth is that AI hasn't really impacted it yet. It's crazy to think that a lot of what's been driving so much of the data center, yes, there's cloud computing, but then cryptocurrency is a huge user of a lot of this power in these data centers, which is crazy to me that bubble hasn't popped. Maybe I'm just too old to understand crypto. But I want to read to you from an article in The Verge. AI and crypto mining are driving up data centers' energy use. Because Tucker, you're exactly right. I mean, the data centers used to require sort of 10 kilowatts per rack. And then they're using more like 20 again for cloud computing. But the AI and the crypto are pushing now to like 100 and 200 kilowatts per rack. So it's just this massive power grab. It's outstripping the grid. All these companies are looking for other ways to pair power supply with the building. Microsoft's looking at these small modular reactors. AWS, also Microsoft doing natural gas. Google's doing novel geothermal. The startup ECL is trying to use hydrogen fuel cells. It's all about power. And I want to read to you from that article in The Verge. Data centers could gobble up twice as much electricity by 2026, thanks in large part to the crypto and AI. According to a new report from the International Energy Agency, data centers, cryptocurrency, and AI made up 2% of the global electricity demand in 2022. They used 460 terawatt hours of electricity. By 2026, that could rise to 1,050 terawatt hours. For those of you following along, 1,000 terawatt is now a petawatt. New words we're going to have to learn. That growth is equivalent to adding an extra country's worth of electricity demand. Sweden, for example, under a more modest scenario, or Germany at the most extreme example. I'm just saying there's something going on in the data center space, and we should pay attention there. It happens to be a market segment that's just on fire. And since we're a pod about corporate real estate, I thought we should do a quick update.
Yeah, I think the power side of it could be a whole nother pod. The consumption of power from the electrification of our, transportation, of buildings, of data centers. It's scary that our grid is being taxed the way it is without new power supplies coming online fast enough, right? And it is a real estate thing, because there's companies, I know, Owen, in your market, there's a lot of this new nuclear fusion and fission companies. A lot of these micro units. There's a ton of that kind of tough tech stuff starting out here with Harvard and MIT that's trying to find a way to help support the energy grid, because what we have today will not support the growth and demand. And it's scary what the grid looks like in New England and what their contingency plans are. I may have mentioned it here before, but it's ISO New England's contingency plans include floating diesel barges into Boston Harbor to meet peak electricity demands if demand keeps increasing and supply can't catch up. So it's ugly. What the backbone of our infrastructure will have to do to be able to meet these demands, and I think from that perspective, it's a major impact to all corporate real estate.
By the way, one other point about increasing power per rack, right? The 10 to 20 kilowatts per rack are the existing data centers largely were built to serve that with their air conditioned cooling. When you get to 100 to 200 kilowatts per rack, the air conditioning doesn't work anymore. You have to literally redesign the data center using a water-based cooling system. And it's not like a modest change. Largely, you have to start over. So really interesting to watch that space when we start pushing up the density at the data centers. And there's going to be a next generation data center. The old generation aren't really easily converted to a water-based cooling system.
It's interesting here in Boston. I was just thinking about it, but you think of Boston as a pretty sizable city with a lot of innovation and a lot of tech, and the center of the universe for life sciences. The city of Boston effectively has one data center hub in the city. It's at 1 Summer Street, where all of the connectivity for the city of Boston runs through this one data center. And if you want to tie into that, you've got to be in that building. And there's kind of a couple smaller offshoots that have, and I don't know this world well enough, but that have connectivity into a portion of the entire infrastructure. But if you want to be where you need to be, if you want it all, you got to be in this one building downtown, and they control it all. And it's to me, like listening to the stories of clients and what they charge compared to other options, it's scary. They've got a monopoly on the city, which is scary. I'd love to see a way that a new operator comes in and creates some competition. Just certainly just as a bystander on the side, watching and hearing the stories of some of my clients that have had to deal with this particular operator. It's just wild.
It wouldn't be a episode of the podcast if I didn't bring up a news story that or like an article headline that I think is so fraudulent. So there have been a bunch of these news stories that have been coming out, including in some major publications, talking about how different like super ultra high rise office buildings are selling for $1. And I just think about like how ridiculously misleading this is, right? Like, it's selling for $1 with the assumption of like $200 million in debt, right? Like, so you started thinking about how wrong this is, right? And it's a bit perplexing to me. But I am curious if you all think that we will see eventually people actually sell office buildings that are functionally obsolete for prices that are gasp worthy. Is there a scenario where somebody has a building that can't be retrofitted to apartments or something that's forever going to be vacant, that's not worth the TI dollars to invest into it, and it ends up selling for an amount that is equal to the land price minus demolition costs, and say maybe that number, if it's in a urban environment or something where it's really challenging to demolish safely, maybe that number is $1 or something really inexpensive. I'm curious if you all have any thoughts.
Yeah, I'm doing a transaction right now where it's a gross lease, but on a net basis, the rent is $3 a square foot annualized, not monthly, annualized. So in other words, the landlord is charging the tenant rent enough to cover their operating expenses and make $3 annualized per year. I mean, it's crazy. But the reason being is there is not a tenant in the Pacific Northwest. Notice I'm not saying Seattle, I'm saying the Pacific Northwest that would want to be in this building. And so I think there comes a point where this person is obviously amenable to making almost no money on their building, but I think there are cases where someone like that might say, this isn't even worth it, because if I had some sort of repair or something, I mean, I barely have enough money in rent to cover my reserves. So yes, there are buildings that are functionally obsolete, I think, in every city in America. It doesn't necessarily have to be downtown. It could be in suburbia. And someone's going to see the highest and best use being taking a wrecking ball and developing it to be something else. Do I think that's going to happen in large scale? Absolutely not. I want to stress that. But are there a few buildings here and there? Absolutely. I could name them right now.
How about this? If they're making money elsewhere in their portfolio, they can donate that building to the Nature Conservancy and turn it into a cool little park. More parks. If that's what comes out of this, that would be a nice little upside.
I think that's a great idea, John. But the challenge with this, and I'll tell you a story. It's the carry cost of the buildings, right? So if the building sells for $1, it doesn't mean it costs $1 because these buildings still have big tax bases. They still have expensive operating expenses. Still got to buy power. You know, in California, in Seattle, and Boston, it's 16, 14 cents per kilowatt hour. There's a story of this building called Cross Point in the far outer burbs. It's a kind of 1 million square foot, two tower complex in Lowell, Massachusetts that was built by one of the old tech giants of New England. I forget which one. It could have been like Compaq, or I forget, truthfully. But it was sold like 20 years ago in bankruptcy for $500,000. And it was bought by this local developer. I think there's like two partners that were barely in the industry. And why it was such a risk, though, is it probably cost a couple $1 million a year just to operate. It was almost fully vacant. And then, a few years later, they turned around and sold the thing, did some leasing, put some money into it, sold it for $100 million. And then I think 10 years after that, it sold for $250 million, right? So when you look at these buildings, it's not about what the sale price is in this market. It's really about what the carry cost is. And then what your land value is not just your demo costs. It's your demo cost minus the carry cost until the date you can demo it. And then add in all the environmental costs. If it's an older building, the remediation of any of that demo could be, could make it truly a negative deal for you. So it's not as simple as looking at these, $1 transactions. I think there will be some $1 transactions that come out, and it's really just to get it off the books because it's costing so much money to carry.
Yeah. I think that there's probably a more efficient way to get rid of a building versus like running a sale process and then eventually selling for $1. There's got to be some kind of like quick claim deed to the city or, donation methodology. Not something I know very much about because at least for my career, I have yet to see anyone be like, please just take the building. I can't, it's worth $0 to me. Even if there's no debt, I can't cover the carry costs and it's worthless. Take it for free. But I'm sure there's some methodology, whether it be donation to the Nature Conservancy or something like that. But anyways, that's episode 30. Happy birthday to America, not the country, but Brian Connolly's dog. Thanks so much, everyone, for listening. We'll be back soon with episode 31.